Let's get to a playbook for Middle East markets with Ryan Leman. He's the co-founder and CEO at Neovision Wealth Management. Ryan, welcome back to the program. Around the world, liquidity is being sucked out of the system. You can hear it, it's sort of getting vacuumed off the playing field. When you look at Gulf markets, when you look at liquidity in this part of the world, what immediately comes to mind in terms of potential trouble spots?
Well, to be honest, Yousef, I don't see much trouble here in the GCC. The GCC is in a very good place. Let's start top down. From a government perspective, balance sheets are amazing, very low debt. On a company level, companies are flushed with cash. I don't really see this as a concern. If any, this reduction in liquidity and monetary base will control inflation a little bit, which is relatively low in the GCC, but it will control it a little bit. It will have a much bigger effect.
What about Saudi Arabia? We had liquidity issues a little bit in the past. Arguably, this is something specific to certain legacy structures within the system, but the interbank rate initially got up. That's going to be in focus again this time around. But that doesn't necessarily turn you away from, say, Saudi banks.
Absolutely not. No. Saudi Arabia today is boiling with activity. There is really a lot happening in Saudi Arabia. So most of the investment bankers here in Dubai are traveling back and forth to Saudi Arabia to cater for deals, and activity is really going up. So as a few months ago, we're still very positive on the GCC equities in general, and particularly Saudi Arabia and UAE, and particularly banks.
Okay, well, with that in mind, where does the dollar strength begin to turn into a headwind for some of the companies in the Gulf? Because, yes, sure, it's great news if you have, domestic production or manufacturing, but it's a bit of an issue if you have to actually sell to the rest of the world, isn't it?
Oh, absolutely. Yes. Now, as we know, the GCC is a net importing country rather than a net exporter. Currencies are pegged to the dollar. So this is very good for the GCC companies in general, because they're importing their goods, their primary goods to manufacture. And this is lowering their cost of production. And that's why we're seeing inflation relatively tame here in the GCC. Now, regarding exports, yes, I would say limited impact. It will have an impact for certain very specific consumer goods going to Arab countries where currencies are not pegged to the dollar, but I see the effect quite limited.
What about the relative outperformance of Gulf stocks? Because I look at the SGCCPUX index, which is the sort of the benchmark in this part of the world, compare that to the S&P 500, and yes, you have a differential of probably about 10, 15 percentage points. Does that continue? Is that sustainable if the global economic narrative turns recessionary, right? So this is an issue for this part of the world.
Oh, absolutely. Now, what we expect that will happen is this differential will increase, and not because of the outperformance of the GCC, which should be flattish given everything that is happening in the world, but rather for the underperformance of the rest of the world, and specifically US stocks and European stocks. So we should see this differential increasing, but again, not because of weakness of the GCC itself.
I mean, we're looking here at Egypt, at a chart that compares year to date some of the stock performance versus the emerging market index. And Egypt's been a laggard for many years. I look at the currency, it's cheap, maybe not cheap enough. We have a central bank decision today. What are we going to get from them? And could there be anything that they say that might get you interested in either the bond play or the equity parallel?
Well, Egypt is in a tough spot. So we see the Egyptian pound weakening a little bit more. Core inflation is in the mid-teens, and that's substantial for Egypt. We do expect the Egyptian central bank to increase by 100 basis points. Again, it's the usual conundrum of having to cause an economic slowdown to control inflation. So for now, we're cautious about Egypt and cautious for emerging market countries in general that have currencies not pegged to the dollar.
What is the breakdown in terms of asset allocation in your average portfolio? I mean, what's the shift been? Because you say, the dollar strength is going to stay. At the same time, you're cautious on ex-GCC equities, but optimistic on regional equities. So what's the breakdown? And if you're bullish, are you buying?
Yes. So we've had a cash allocation of 40%. We've increased it to 50%. This allocation is split into US dollar, Swiss franc, Swedish krona, Brazilian real, etc. So these are currencies we expect to continue strengthening over time. As for risky assets, so we're positive on GCC equities. We are short equities, short credit in general, long treasuries. A 2-year at 4% is a good buy today. And most importantly for us, the best inflation hedge is private equity and private investments, which we're also long on.
All right, we'll leave it there. Thank you very much, Ryan, for that. That's Ryan Lemon. He's the co-founder and CEO of Neo Vision Wealth Management.